If you're just starting to invest, you may have heard about passive investing, but you might not know exactly what it means or how it works. In today's video, we are going to provide an overview on what is passive investing. But before we continue, kindly like this video, subscribe to the channel, and hit the bell icon to stay notified of more interesting videos just like this one. With that done, let's get right into the video. To understand passive investing, think of the saying slow and steady wins the race. Passive investing is a long-term strategy for building wealth by buying securities that mirror stock market indexes and then holding them long-term like fine wine. The longer you hold your investments, the longer they have to mature and give you decent returns. It's a popular type of investing. According to a 2021 Gallup Investor Optimism Index, 71% of U.S. investors surveyed said passive investing was a better strategy for long-term investors who want the best returns of those surveyed, and only 11% said timing the market was more important to earn high returns. A majority, 89%, said timing the market was more important. Passive investing, also known as passive management, is a thoughtful, time-honored philosophy that holds that while the stock market does experience drops and bumps, it inevitably rises over the long haul. So rather than trying to outsmart it, the best course is to mirror the market in your portfolio, usually with investments based on indexes and stocks, and then sit back and enjoy the ride. Simple to understand and easy to execute, passive investing has become the go-to approach for many investors. Here's how to join them. The essence of passive investing is a buy and hold strategy, a long-term approach in which investors don't trade much. Instead, they purchase and then hang on to a diversified portfolio of assets, usually based on a broad market-weighted index like the S&P 500 or the Dow Jones Industrial Average. The goal is to replicate the financial index performance overall, to match, not beat the market. Perhaps the most common passive investing approach is to buy an index fund tied to the market. These sorts of funds are often known as passively managed or passive funds. The underlying holdings in passive funds can be stocks, bonds, or other assets, whatever makes up the index being tracked. If the index replaces some of the companies included in it, then the index fund automatically adjusts its holdings, selling the old stocks and purchasing the new ones. Thus, investors profit by staying the course and benefiting from the market increases that happen over time. Typically, index funds specialize in areas such as equities, fixed income, commodities, currencies, or real estate. Choosing different types of funds depends on the investor's desire for income or growth, risk tolerance, and the need to balance the portfolio. Fixed income bond funds generally act as a counterbalance to grill stock volatility. For example, while foreign currency funds can help provide a hedge against the depreciation of the US dollar, there are many key features to passive investing. The ultimate goal of passive investing is to build wealth gradually, as opposed to making a quick killing of key characteristics of passive. The strategy includes an optimistic outlook. The core principle underlying passive investing strategies is that investors can count on the stock market going up over the long haul. By mirroring the market, a portfolio will appreciate along with its low costs thanks to its slow and steady approach and lack of frequent trading. Transaction costs, commissions, etc. are low with a passive strategy, while management fees charged by funds are unavoidable. Most ETFs, the passive investor's vehicle of choice, keep charges well below 1% diversified holdings. Passive strategies also inherently provide investors with an efficient, inexpensive route to diversification. That's because index funds spread risk broadly by holding a wide array of securities from their target benchmarks with less risk. By its very nature, diversification almost always brings with it less risk. Based on the funds they choose, investors can also diversify their holdings further within sectors and asset classes with more targeted index funds. While passive investing has many great benefits, it also has its drawbacks too. Live by the benchmark, die by the benchmark index funds. Follow their benchmark index regardless of the state of the market's translation, though rise when the index is performing well, and they'll also drop when prices decline. And if the whole market goes into free fall, you will see it reflected in your portfolio's lack of flexibility. Even if index fund managers force a decrease in the performance of their benchmarks, They typically can't take such steps as cutting back on the number of shares they own, or taking a defensive counterbalancing position in other securities. Fewer windfalls. Since passive funds are designed to mirror the market, investors are unlikely to experience the big coups that actively managed funds can sometimes provide. In other words, not catching that rising stock star. Even if a fund did, it might not benefit as much since the returns would be mitigated by other holdings in the portfolio. Less pain, but less gain. Buying and holding can be a winning tactic in the long run, at least a decade or two. You weather the market volatility, but evening out the risks also flattens out the rewards in shorter time spans. Active investing often provides better results and juicier gains. Now, let's go over a brief history of passive investing. Though buying and holding onto stocks is nothing new, passive investing as an official strategy first emerged in the 1970s with the creation of the first index fund for individual investors. It was a new type of mutual fund pioneered in 1976 by John C. Bogle, the then CEO of investment company, the Vanguard Group, namely the Vanguard 500 Index via INX. It allowed thousands of regular investors to buy shares in a fund that mirrored the S&P 500, an index that is widely seen as a stand-in for the stock market overall, with prices cheaper than many mutual funds at the time. It enabled the little guy to have a stake in some of the market's best companies without the cost of buying them individually and without much effort. Other companies followed suit in offering in index mutual funds. Then, in the 1990s, came another innovation: exchange-traded funds. They too were designed to track various indexes, and with even lower management fees than mutual funds and also greater liquidity. Since ETFs trade throughout the day on exchanges like stocks themselves, cheap, diversified, and low risk, they were tailor-made for a buy-and-hold strategy and vice versa. It was the advent of ETFs that really made passive investing part of the financial conversation, especially for retail investors. Passive investing has become the strategy of choice for the average retail investor. It's an easy, low-cost way to invest that removes the need to spend a lot of time researching stocks and watching the market. The fundamental principle of the strategy is that, in the long run, those who wait will benefit financially from the market's growth, and that little trading results in maximum rewards. While the buy-and-hold approach has a few downsides, it doesn't suit everyone. In the end, investors who want to remain hands-off and have long-term goals, such as saving for retirement, are better suited for passive investing. On the other hand, investors who prefer more active management of their portfolios or don't have the patience to wait are probably not a good fit for a passive strategy. If they want to try beating the market and are willing to pay higher fees to do so, an active approach is a way for them to go to many financial advisors. Utilize passive investing as their main investment strategy. Finding the right financial advisor that fits your needs doesn't have to be hard. Smart Assets free tool matches you with financial advisors in your area in 5 minutes. If you're ready to be matched with local advisors that will help you achieve your financial goals, get started now. Robotic financial advisors are an excellent substitute for more expensive financial advisors for those with less money to invest. In fact, many robo-advisors already incorporate plenty of index funds, ETFs, and mutual funds in their portfolios. As a result, passive investing is a major centerpiece in the robo-advisor community. That brings us to the end of this video. If you enjoyed this video, please leave a comment and let us know. And don't forget to like and subscribe to stay up to date on all of our new content. See you soon. Thanks for watching.